Good evening and welcome to Class 3 of F8 Audit and Assurance Revision. I tried to start this class about 2 minutes ago, but we had a little technical blip. Things were working but were looking a bit strange for you, I think. So we decided to reset the system to make things a bit nicer. So as I was saying, but you might not have been hearing last time, where have we got to in our revision? Well, our main focus has got to be on the 70 marks of long questions. 3 core topics that are going to be coming up in there: audit planning, internal controls, substantive procedures. We've done our audit risk and response questions, so we know what's going on with those. We've started some internal controls and we'll be doing some more of that tonight. And then we'll be moving into substantive procedures also from this evening, so that by the time we get to the end of this third class, we will have hit very hard all of the big 3 core areas. We've also done some ethics, of course, as well as looking at some other bits and pieces from throughout the course, which are likely to form smaller marks questions and also MCQs. When would we get the marking for the mock? When I have marked the mock. I don't know what deadline has been put up on the system, but please bear in mind the mock exam window is open until tomorrow. I don't normally start marking until I can see how many scripts there are. It is not very easy to be marking the mocks a few at a time. I really need to mark them all in one big go. Plus, I've just been teaching all weekend and evenings, so I haven't started yet, to be honest. So I would imagine I will start marking the mocks on Wednesday. How long will it take? I don't know. Depends how many mocks there are to mark. But since you have taken such a strong and professional interest, Ashok, and also your name begins with an A, I'm sure I can make sure your script is a nice way up the pile. So I will get back to you with that as soon as I can. Right, so let's get on with class number 3. At the end of our final class, we were looking at internal controls, and we did an internal control question with deficiencies and recommendations in it. We're going to be moving on and doing another internal controls question shortly, but just before we do that, I think another little bit of technical revision on something totally different, just to warm our brains up a bit and tick another box to make sure we're not ignoring all the knowledge. So, what we will do is we will start with a look at Audit Standard 250, which is all about laws and regulations. So, why does the auditor, the external auditor, need to know the laws and regulations affecting their client? Because surely following laws and regulations is up to the company, nothing to do with us. And that's true. It's not our job to make sure they're following laws and regulations. The reason that we care is because we care about whether the financial statements are true and fair. And if your client is not following the laws and regulations that it should be following, it therefore follows that the accounts might be misstated. Why is that? Well, if a company breaches laws and regulations, you can't send a company to prison, so typically they're likely to get fined. And if they have breached the law before the year end, then that means that at the year end, they are going to have an obligation to pay that fine. And therefore, since we are talking obligations, under Accounting Standard 37, I think your client needs to have a provision in liabilities. So one reason we need to know if our client is breaking the rules is if breaking that rule could lead to a fine that would be material and therefore we would care about for the financial statements. If we're talking about breaking rules and getting fined $5, then who cares? But if it's material to the accounts, we would want to know about it. However, if a company really goes for it and seriously breaks the law, well, either the fine could be huge, or they could get their license to operate removed. And if we're talking that sort of scale of problem, well, that must surely cause a material uncertainty relating to their going concern position. And under Accounting Standard number 1, such going concern uncertainties must be disclosed by the company in a financial statement note. So, to recap, we need to know about the laws and regulations affecting our clients if those laws and regulations, if breached, could lead to a material fine or a fine so huge or the potential for a license being revoked that could lead to going concern uncertainties. So that is why we need to know. And if when doing an audit, you discover a breach, then who are you going to tell? And as you might remember from another question, when you discovered fraud, generally there are 3 things you want to say here. You should make sure management are aware that they are breaking the law, because they might not know. So tell the executives. The audit committee, assuming the company has an audit committee, would also want to know if laws are being broken, because this is one of the things they oversee. And you might need to consider reporting this externally if you think it is in the public interest for the world to know that your client is breaking the law. If you are going to take that approach, then you should take legal advice, because breaching a company's confidentiality by going external is a slightly dangerous thing to do. Right. So there's a little gentle knowledge warm-up before we get going into the more important stuff. Now it is time for us to have a look at our second internal control question for this revision course. The question we're going to be looking at is from the June 2014 exam, and question number 1. Up until June 2014, there were no multiple choice questions on this paper at all. There were 5 long questions, and they were 30 marks, 10 marks, 20, 20, 20. Then from December 14 onwards, the 30-mark questions disappeared. Now, of course, there is a 30-mark long question again. So I don't think it's any bad thing for us to practice a 30-marker, because you'll be doing one on exam day. Okay, so let's go take a look at it and see what it covers. We know there'll be some internal controls in there, but there's going to be some other stuff in there as well. So for the purposes of doing this question, we must now pretend it is June 2014. That is today's date. And here comes question number 1. And as with all the long questions that you're going to do on exam day, don't read the story. Go read the requirements right at the start of the exam for every long question, and let's see if we can see some question types that we recognise and we have got an exam technique for. Part A. In respect of the payroll system of trombone, identify and explain 5 deficiencies. Well, we know what we're doing with those, don't we? We'll probably see them anyway, but just in case we don't, we will look out for the word not, because anything we're told they're not doing, they probably should be. We'll look out for clerks, because we know that clerks are meant to be junior and they should be making no decisions, not doing anything too important, just processing basic data. We'll also look out for anything done manually, which could surely be automated, and anything done verbally, which surely could be put into writing. Now, whether you need examples of the things to look out for, I'm not entirely sure. Generally, it's fairly easy to spot the deficiencies, but just in case you're not sure, those are the sort of things we're looking for. It also says explain those deficiencies, and when we explain the deficiencies, we explain them in terms of the potential damage to the company. So things like if it could cause increased fraud, increased theft, upset staff, upset customers, damaged reputation, things like that. Part 2 then says recommend a control to address each of these deficiencies. And as we saw in class number 2, when you recommend a control, don't just say the deficiency the other way round. Deficiency, they don't do X. Recommendation, do X. Add something. Try to say who should do it, how should it be done, or maybe how often should it be done. But this question, unlike the last one we did, goes further, because this one also wants a test of control that we should perform to assess if each of these controls is operating effectively. Now, the test of control will depend on whatever control procedure you have recommended. So, important point, when in part 2 you are recommending a control, try to make sure it's one where there's a fairly obvious way of testing it to make sure that control is working. How do we test controls? Well, on this course, we have 5 types of test, A, E, I, O, U. And for tests of controls, I find the middle 3, E, I, and O, are the most likely. We ask the staff, is the control happening? We inspect bits of paper to look for signatures suggesting someone has done something, or we watch the control happen, observe. So the first half of the 30 marks available here, 15 of them, are for a completely standard report to client on control deficiencies, and we should know how to deal with that. Part B, as we would expect on the exam, there'll be a few 4 or 5 mark questions on technical knowledge. And for 5 marks, meaning we want to try and say 5 things, we need to explain the difference between an interim and a final audit. Now, I think that part of the question requires no reading of the story at all. It's a pure technical question, and I'm therefore tempted to go and map out my answer for that one right now. There are 5 marks available, and if there are 5 marks available, we want to say about 5 separate things about interim and final audits. So, I would be thinking to say that an interim audit is done before the year end, whereas a final audit is done after the year end. Now, are those 2 separate points, or is that one comparison, worth 1 mark? Well, until I've got as many ideas down as I can, I don't know. So don't start writing the actual answer till you know you've got about 5 points. Interim audit is done first, and therefore must involve the early stages of the audit process, which is planning the audit and assessing and testing controls. It might be possible to do some substantive testing to check the recording of the numbers that have been happening during the year. You know, the selling, the purchasing, the expenses. Whereas the final audit is whatever's left. So, final substantive procedures. And I'd also be tempted to say that the final substantive procedures you will do are going to be affected by the results from the interim audit. In particular, how well the testing of controls went, because of course the results from testing of controls will have a direct impact on how much substantive testing we then do. And then the rest of the audit process, finalisation and the writing of our audit report. I would also say that the interim audit is up to the auditor. It's especially useful where you've got tight deadlines after the year end, because when you've got tight deadlines, the sooner you start doing the work, the better. Whereas a final audit always takes place. And at that point, I'm starting to struggle for things to say. And if that's the case, that tells me that it should be possible, given I've not got 5 separate comparisons up there. I've only really got 3, haven't I? That tells me that it must be a mark for that, 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 and a mark for that. They must be a mark each because there's nothing else to say. So that's interim and final. Parts C and D are like part A. They are practical, and they'll probably involve having to read the story, and we are going to have to come up with some ideas. What I like about these 30-mark questions is they often have not just internal control stuff in them, but also some substantive. So they're very good questions in that they cover 2 of the core marks areas on the course. Part C, substantive procedures. And the moment you see substantive, you should be thinking, we will be testing assertions by doing a selection of procedures, A-E-I-O-U, on evidence, DAR 3. Documents, assets, etc. No, the interim audit is done by the external auditors. The interim audit is part of the external audit. It's the bit you do before the year end to help plan for the stuff you do after the year end. Okay, so I'm doing substantive procedures. There are 6 marks and therefore I need to come up with 6 procedures. I'm performing these at the final audit. So if you didn't know that most substantive procedures are done on the final audit in Part B, then Part C is giving you a rather helpful clue, isn't it? What are we doing? We are confirming the completeness and accuracy of Trombone's payroll expense. Please note, we don't have to think which assertions to test because your examiner has limited it to just 2. Now, payroll expenses are in the statement of profit or loss. That means the assertions that we should normally be thinking about for profit or loss would be completeness, occurrence, accuracy, classification, presentation, and cut-off. But because your examiner has said completeness and accuracy, don't you dare suggest any tests that cover the other assertions, because if you do, you will get no marks for them. So, completeness and accuracy. There's no split of marks for how many completeness and how many accuracy tests we need, so there's no need to divide the answer up. But you've got to make sure that your tests are aimed at those 2 assertions. Now, obviously, there is a story, and we've not even begun reading it yet, but surely there are some substantive tests on payroll expense that we would do at every company. Six tests are needed. How do I know if the payroll figure for expense is complete? What does it mean, complete? Complete means that everything that should be in there is in there. Well, surely it will be complete if the payroll T account, well, if this company pays weekly, there should be 52 weekly totals in the payroll T account. If they pay monthly, there should be 12 monthly totals in the payroll T account. Or if you want to look at it another way, if they've got 5,000 staff, in total there should be 5,000 times 12 months or 52 weeks of payments. So it will be complete if it's got the entire year in it. I haven't read the story yet. I don't know what the story will tell me. I'm guessing it will tell me something about how the staff are paid. So there's idea number 1. I won't write the answer in full until I've read the story. Let's try an accuracy one. Payroll is full of numbers, so accurate numbers, which is what accuracy means, is probably going to generate quite a few ideas. So what sort of calculations need to be checked? Well, I could add up the payroll T account to ensure the total is correct and matches the balance that's been put in the profit or loss. I could also get a sample of payslips for staff during the year, and the figures on the payslip need to be checked for accuracy. What are the figures on the payslip? Your gross pay minus deductions for tax, national insurance and stuff like that. Well, those are two separate things to check. Firstly, how do you know what someone's gross pay is? It will be on their personnel file. So agree, gross pay to the employee's personnel file. Then there are deductions for tax and national insurance. I suggest we need to recalculate the tax and NI deductions using the employee's tax code and tax and national insurance laws and rates. Now I'm looking for 6 tests here and I've already got 4. But I think there are more. Because to help check that the total expense looks like it's accurate, thinking AEIOU, I could analytically, i.e. compare, a number of things. I could compare this year's total expense to prior year. Adjusting prior year, of course, to add this year's starters, remove the salaries of leavers, add in a pay rise of some sort. So I can take last year's payroll, bump it up for starters and pay rises, bump it down for leavers, and that should give me a pretty good estimate of what this year's figure should be. But I can also, with payroll, compare this year's actual figure to budget. Because payroll is normally set in advance, people's salaries don't change much during the year, and the budget should be a pretty good predictor. I could also compare payroll monthly, or if the question says weekly, because payroll costs should be pretty fixed, pretty consistent month by month, and investigate any fluctuations. And assuming all of these work, and I've not read the story yet, 1, 2, 3 compares, 4, 5, 6, 7, I've already got enough. Now, I haven't yet read the story. So there is a bit of a risk in what I've planned here, and I will need to read the story and adjust this before I write the actual answer. For example, I have compared gross pay to employees' personnel file on the assumption they're paid a fixed salary each year. And as Ashok has correctly speculated, what if they're not paid a fixed salary? What if they're paid based on the hours they've worked? In which case, I'd need to check their gross pay back to timesheets or clock cards. But since I've not read the story yet, I don't know how they're paid. I find stories can muddle your head. If you can work out as much of the answer before you read the story as you can, then read the story, adjust your plan and add anything else that comes into your mind. Yes, another perfectly sensible thing to do is to check the tax deductions to the figures that are being paid to the tax authorities. And if the tax authorities aren't complaining the figures are wrong, presumably they're right. But there is a reason, Lorraine, why I have not put that in this answer. And the reason I've not put it in this answer is I did have a cheeky little look at what Part D was asking. And Part D of this question says, describe the audit procedures. Notice it does not say tests of control or substantive, which means you could do either in your answer. If the question is not specific, feel free to go with whichever ones work for you. Required in respect of the year-end accrual for tax payable on employment income. And then above that, there's a little story, although the story just explains what the question is asking. Trombone deducts employment taxes from its employees' wages on a monthly basis. Ooh, they're paid monthly. And pays these to the local taxation authorities in the following month. At the year end, the financial statements will contain an accrual for income tax payable on employment income. Because, of course, the final month's payroll, the tax and deductions will be paid after the year end to the tax authorities. And for 4 marks, we've got to come up with audit tests for that accrual. And I'm thinking that Lorraine's suggestion is going to be the first test I'm going to write. AEIOU. I'm thinking inspect, because if those deductions are paid over in the month following the year end, they will have been paid before my audit of the accounts finishes, which means I can check the payment as it's made. So I would inspect the post year end bank statements and cash book to verify, always explain why, the amount paid. Now, tax authorities is a perfectly safe thing to say. Because it's quicker, I would write Her Majesty's Revenue and Customs, the UK tax authorities, purely to save a bit of time. But wait, how do we know they've paid the right amount? What is the right amount? The right amount is whatever deductions came out of the final month of the year. What was the year end? I've totally forgotten. Does it even tell you what the year end is? 31st of August, 14. So I would agree the year end accrual back to the August 2014 payroll figures to ensure, verify, whatever, that the accrual equals the deductions that month, because that is what it should be. So in terms of my tactics, AEIOU, I have inspected some documents, bank statements and cash book. I have also inspected the accounting records, the payroll records, to help verify what the year-end deductions were. I'm also thinking that after they pay this to the tax authorities, if the tax authorities aren't happy, they will write back and say, I don't think that's the right amount. So to find out if the accrual has been correct, I would inspect correspondence between your client and the tax authorities post year end to see if the tax authorities have accepted the post year end payment or are disputing it. And that will help to tell me if that figure was accurate. Ashok, absolutely. You are describing the audit tests that you will do on the final audit after the year end. So absolutely, there is nothing wrong, in fact, everything right in proposing the audit tests that will be done in the future. Yes, 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 yes. The simple fact is you can't check the year-end accrual now because the year-end has not happened yet, so there is no accrual yet to check. Right, I've got 3 tests and that's great, but I need a 4th one. So now, if you can't think of anything, AEIOU, DADA3. A, analytical. Is there anything we could compare the year-end accrual to? Yes. There's my 4th one. Compare the year-end accrual with whatever they've accrued at every other month end. Because if payroll is fairly consistent, surely the deductions each month will be consistent as well. And there is an answer to part D. Which means I have pretty much answered parts B, C and D without reading the story. Exams are of course very time-pressured things. If you're the sort of person who regularly falls behind time, my suggestion to you is go and write the answers to as many parts of questions as you can that don't require reading the story. Because reading stories and thinking about stories is what tends to eat up a lot of the time, doesn't it? Right, half the question is done. Part A, of course, we can't do deficiencies unless we read the story. Before anyone asks, by the way, are you allowed to answer the questions parts B, C, D and then A? Yes. As long as it's obvious to the marker which bit of the question you are attempting, so label your answers carefully, that will be absolutely fine. So part A of the question, we need 5 deficiencies, 5 recommendations, and 5 tests of control. So I would do this as a 3-column answer. That immediately is taking a risk. These columns are going to be pretty narrow, and especially if you've got big handwriting, you're not going to get many words along the line before you have to go down. You don't have to do it as 3 columns. You could say, here are deficiencies, 1, 2, 3, 4, 5. Then have a heading, recommendations, 1, 2, 3, 4, 5. Tests of control, 1, 2, 3, 4, 5. So if you're worried about 3 columns, absolutely understand. Don't do 3 columns then. Here we go. Trombone operates a chain of hotels across the country. They employ in excess of 250 permanent employees. Year end 31st of August 2014. You are the audit supervisor of Viola & Co. and are currently reviewing the documentation of the payroll system detailed below in preparation for the interim audit. Okay. Permanent employees work a standard number of hours per week as specified in their employment contract. However, when the hotels are busy, staff can be requested by management to work additional shifts as overtime. This can either be paid on a monthly basis or taken as days off. So, in the payroll expense substantive procedures part of our answer, part C, now you've read the story, we've got another thing to check, haven't we? Because there'll be some overtime claims and we need to check that those overtime claims have been paid accurately. I didn't think of that before I read the story because I hadn't read the story. So if you're short of answers in part C, reading the story will help to fill them out a bit. But so far I can't see any obvious deficiencies. Employees record any overtime worked and days taken off on weekly overtime sheets which are sent to the payroll department. Okay, still can't see a deficiency. The standard hours per employee are automatically set up in the system and the overtime sheets are entered by clerks into the payroll package. Okay. Which automatically calculates the gross and net pay along with relevant deductions. I still can't see anything wrong with this. These calculations are not, hooray, checked at all. So we got one. Wages are increased by the rate of inflation each year, and the clerks are responsible for updating the standing data in the payroll system. Clerks should be processing basic things only. I do not like the fact that they are updating people's pay rises. That looks dangerous to me, and that would be my second deficiency. I'm not writing any of it yet because there may be more than 5, and in my answer I want to pick 5 nice, easy deficiencies to explain where there's an obvious recommendation and I can do a test of control. And I'm not writing any of that until I've read the whole story and can see how many deficiencies I can find. Employees are paid on a monthly basis by bank transfer. So, in your answer to part C, you now know that monthly. So if you're testing completeness, there should be 12 monthly totals in the payroll T account. So, by bank transfer for their contracted weekly hours and for any overtime worked in the previous month. If employees choose to be paid for overtime, authorization is required by department heads, that's good, not bad, of any overtime in excess of 30% of standard hours. Which means that's another not, because any overtime of less than 30% of standard hours doesn't need authorization. It is not authorized. And I can't help feeling that if overtime is only being authorized for people who work more than 30% of their standard hours, any sensible employee is going to claim to have worked 29% extra, knowing that no one's going to check it, which means they don't actually have to work it. If employees choose instead to take days off, the payroll clerks should check back to the overtime worked report. However, this report is not always checked. So we've now got a fourth problem. 3 nots and 1 clerk. The overtime worked report, which details any overtime recorded by employees, is run by the payroll department weekly and emailed to department heads for authorization. Good. A strength, not a deficiency. The payroll department asks department heads to only report if there are any errors recorded. Meaning, of course, they are not required to say yes, the figures are right. So that would be another one, and I've now got 5 deficiencies. Department heads are required to arrange for overtime sheets to be authorised by an alternative responsible official if they are away on annual leave. However, there are instances where this arrangement has not occurred. Your examiner's being very generous here. We have got 3 obvious knots, 2 indirect knots, and a clerk. The payroll package produces a list of payments per employee. This links into the bank system to produce a list of automatic payments. The FD reviews the total list of bank transfers and compares this to the total amount to be paid per the payroll records. Sounds good. If any issue arises, the automatic bank transfer can be manually changed by the finance director. I don't think I like the idea of the finance director being able to fiddle with the figures at the end, especially as the finance director will be on the payroll. Surely, if there's some sort of problem, the finance director should go back to the payroll department and get them to check their figures. Shouldn't they? Well, I think I've got 7 possible deficiencies, but I only need 5. So I'm going to go for 5 that I am happy explaining. I might put a 6th one in if I absolutely have to, but to be honest, if you've got 5, that's fine. So, first deficiency is that the automatic calcs on the payroll system are never checked. Well, that's just copying out the question. I've not added anything yet, so I need to add. Yes, Ashok, I agree. If all they're doing is checking the total, they can't see what individual employees are getting, then there is a risk that there are names on that list who shouldn't be there at all, or amounts being paid to individuals which are excessive, I guess. Anyway, we've got enough, so let's get on with it. Automatic calcs are not being checked. So what? If the computer program has a fault, it will make the same error repeatedly. Meaning that staff or the tax authorities get the wrong amounts. Now, I suspect that is enough to write, but you could go on and say if you underpay your staff, they'll be upset. If you overpay your staff, you'll probably struggle to get the money back off them. And if you underpay the tax authorities, when they get upset, they fine you. So for all sorts of reasons, automatic calcs, well, that's great, but someone ought to check them every so often and make sure they're right. Recommendations. Check the automatic calcs. Very good. Say how or who or how often. So I would say that every month, someone important, how about the payroll manager, should pick a random sample of payslips and manually check all the calculations. Test of control. You are the auditor. You recommended that this check should be done by the payroll manager, and now it's time to see in the future if that check is now being done. How do you know if the payroll manager is doing this? Well, you could ask the payroll manager if they do any checks, but surely the best thing to do is realise that when they check a payslip, they would surely initial it to show it's been checked. So I would inspect payslips to see evidence of the payroll manager's signature, initials or whatever, showing that the checks were done. Of course, if the payroll manager actually found any problems, then presumably they would email the payroll department and say, look, there's something going wrong here, in which case there are email trails that would help to verify that these checks have been done. So, deficiencies, explain why. Recommendations, add some detail. Test of control, how could an auditor know that the recommendation you've made is being done? Secondly, clerks are responsible for updating for pay rises. And my concern is that if clerks update the system for pay rises, they might make errors or put through fake pay rises for themselves or for colleagues. I think people's salaries are a very important and sensitive number, and I don't think you want low-level members of staff playing around with them. I would recommend that only the payroll manager, or maybe even the finance director, should have a password that allows the ability to change salaries. Now, I think it's said in the story that everyone automatically gets an inflationary pay rise. So another valid suggestion would be someone important, maybe the finance director, should program in the annual inflation rate and then let the system automatically upgrade people's salaries and take the human element out of it entirely. How do we know that only one password gets in to be able to check salaries? Easy. All you do is try to access salary information and change it using the passwords of lower level staff. See if it's possible. What you're doing there is an example of test data. You are faking something to see if you can get in and make the system do something that it shouldn't be doing. Two down, 3 to go. Third one, overtime in excess of 30% is authorised. Therefore, overtime less than 30% is not. So, if overtime claims that are less than 30% of standard hours are not authorised, staff are likely to put in fake claims for 29% extra hours. And they'd probably get paid, wouldn't they? Recommendation. Department heads should authorise all overtime claims verifying that these hours were genuinely worked. How would you know that all the claims have been authorised? Simple. Pick a sample of overtime claims and inspect the department head's signature to verify it is there. And there's the third one. These questions are not difficult. All they take is a little practice. Making sure that you know when you give your deficiency, you explain why it would be a problem. When you make your recommendation, you add some detail. And make sure you understand what a test of control is. It is the auditor asking, i.e. enquiring, inspecting things for signatures, or observing controls taking place to verify that whatever you recommended is now being done by the client. You will find answers to the June 2014 questions in the revision kit. I've talked you through the first 3 points. It gets a bit repetitive if I keep writing it all out in full. So let me just talk you through the others. The overtime worked report is not always checked, which means, again, there's a risk that overtime is being paid, which was never worked, or mistakes are being made. Department heads are only required to report if there are errors in the overtime worked report. Well, the danger with asking them to only write back if there's a mistake is if they haven't yet written back, does that mean there are no mistakes, or does it mean they haven't checked it yet? It would be far more sensible to say that they should write back and confirm, yes, this is right, or no, this is wrong. Department heads are meant to arrange for someone else to check the overtime when they're on holiday. Sometimes they don't bother. Result? The result is that overtime won't be checked until they get back, which means either the employee gets paid before it's been checked, leading to mistakes, or the employee has to wait too long for their overtime. And this might lead to the employee getting a little bit annoyed that the only reason they've not been paid is their boss is sunning themselves on a beach somewhere. How do you make sure that the department heads do arrange for a second person to do this? Well, there's a number of ways. Make it a disciplinary offence if they don't do it. That will incentivise them. Or do it for them and tell them another person in their department who will be checking this if they don't. Take the decision out of their hands. Okay, I think you get the idea. These questions where you have to come up with 5, 6, 7 deficiencies, once you've shown yourself capable of doing 2 or 3 of them, after that it becomes a very repetitive exercise. Now, doing a question like that is very, very helpful because we have now seen some more internal controls work, plus we've done some substantive procedures. And notice how the last 2 bits of the question, we've got substantive on a profit or loss item, payroll expense, and then we've got substantive on a statement of financial position element and accrual, but both of them are payroll related. Your examiner does this quite a lot. If you get a question about sales revenue, controls, there's a reasonable chance you'll get a substantive testing question on revenue for profit or loss and trade receivables, the other side of revenue, on the statement of financial position. Likewise, if there's a purchases controls question, there's a good chance you'll be doing substantive testing as well on purchases and on trade liabilities, trade payables. Okay, good. A nice 30-mark question dealt with, and now we're getting into some substantive procedures. And with that in mind, we are going to go straight on and do another substantive procedures question. The next one we're going to do is rather more recent, because now we're going to go to the March-June 2016 sample paper. So half the questions from the March exam, half from the June, and we are going to look at question number 2. Which says, describe 5 types of procedures for obtaining audit evidence. So that's your A, E, I, O, U. And then for each one of those, describe an example relevant to the audit of bank balances. Not bank and cash, just bank balances. Right, so 5 procedures. Notice, just like the last part of the last question, it doesn't say substantive or test of controls. It just says procedures, which means we can do both tests of control or substantive. And given we've got to come up with 5 procedures, 1 for each of A, E, I, O and U, the fact that we can go for either will surely help us a bit. So for the first part of this question, you need to explain what the 5 procedures mean. Well, analytical involves comparing financial statement information with other information, things like budgets, prior year, maybe competitor company accounts, to see if the financial statement info looks reasonable. We're not checking it's precisely accurate. Good save, Lorraine. Well done. Well spotted. We're not checking with analytical that figures are 100% accurate. We are checking they look like they're in the right ballpark. A luxury we have because we only have to report if the accounts are materially misstated, not if they're misstated. So if the numbers look about right, that's fine. So that's analytical. Now, strictly speaking, your examiner believes that enquiry is one procedure and confirmation is another. Okay, I suppose enquiry and confirmation means there's 2 things there. But surely asking a question is not a very useful audit procedure if you don't get an answer to that question. So I would pair them up. And inquiry and confirmation, of course, are where you ask people inside the company, like the directors, or third parties, to verify information in writing. The I is inspection, and that is looking at documents or assets or the accounting books to verify information. That information could be the numbers, the dates, the names on documents. It could be that numbers have gone into the correct T accounts in the accounting books. It could be checking the condition of assets or whether they exist. The O, observation, is where instead of looking at something static, a document or an asset, you now watch a process take place at your client. That could be an internal control taking place, or it could be an asset in use. And finally, recalculation is where you reperform a calculation originally done by your client to test its accuracy. So, as with everything on the course, knowing it is helpful, but you do need to be able to explain it all as well. And then we need to apply AEIOU purely to bank. So let's try and fill these in, going for the easier ones first. What sort of tests do we do on bank? Well, one thing we do on bank is we ask the bank to confirm bank balances that the company has. So that will be E, inquiry. And we'll ask them to confirm those figures directly back to us. Well, that one's not too difficult. How else can we confirm bank balances? I, inspect. What could we inspect? Documents? How about the bank statements? And then it starts getting a little bit tricky in my mind. Let's go up to the top. Analytical. Compare. Well, one thing you could do is compare the year-end bank balances with your understanding of the client. Do those balances look about right for the position the client's in? I mean, think about it. Every month you get paid, and shortly after being paid, you've got a lot of money in your account. And a few days later, you don't, because now the money has all flowed out and been spent. So you could compare the year-end balances with what the balances look like at other month ends, to see if as expected. Now that does assume that the cash flow of the company is relatively predictable and that roughly every month end is about the same. Otherwise that's a stupid test to do. But I can't really think of anything else, to be honest. O, observe. Well, normally observation is used for testing controls. So I think I would like to work out what controls are used for bank and then ask myself, could I watch them happen? The most obvious control over bank is the bank reconciliation done by the client. So I suppose I could observe the bank reconciliation being done to verify it is being done and done properly. Other controls over bank, when money is banked, so taken to the bank, it should be done securely and safely, so I could observe money being transferred by a human to the bank, perhaps. But observe's going to be quite difficult, I think. Recalculate. Well, the bank balances are the bank balances. Is there a calculation to do? Well, maybe. Because there is a clue. Because it says bank balances, which means there is a list. And lists have to be added up. So I would check that the list of bank balances correctly adds up to the total in the financial statements. Now that was a little bit harder than I would have liked it to be. I suggest that since this question comes up fairly frequently for different balances in the accounts, over the next 2 weeks you might want to practice AEIOU on as many financial statement figures as possible. Ashok, completely agree. There is a 6th audit procedure because one way to tell if an internal control has been done properly is to go and re-perform it yourself and see if you got the same result. And with the bank reconciliation, that would seem to make a lot of sense. So yes, if as one of your 5 tests you'd gone for re-performance instead, then re-performing the bank rec, absolutely. Wonderful. Well, we've managed to get another question done. It was nice when we had lots of 10-mark questions on the exam because we could get lots of different things practiced. Right, time for another bit of technical revision, I think. I don't think recalculate is a test of control, because that is suggesting that calculation in the first place was a control procedure, and I don't see how a calculation ever would be. Re-perform, that works, but recalculate, I doubt that's a test of control. Okay, let's move on to another bit of technical revision. More questions coming up after our break. But let's have a look at Audit Standard 220. Now this one is really more important, I suspect, because it's on the subject of quality control. That's quality control in your firm. And the reason why this one is perhaps a little more important is that this was only added to the F8 syllabus from the last sitting in September. And whenever anything new is added, the chance of it coming up on the exam immediately increases because it's new and your examiner gets all excited. Right, as auditors, we want the work we do to be high quality. There are 2 things we therefore need to achieve. We need a working environment, which is a high quality environment, and we need specific quality control procedures on each piece of work we do. So the quality needs to attack our firm as a whole, and each assignment we carry out. One way to set a quality control environment is to make sure that senior management are clearly interested in good quality. And the best way to do that is to appoint a quality control partner in your firm. They are going to be in charge of everything to do with quality, setting the quality, monitoring the quality, and doing something about it when the quality fails. That quality control partner will be in charge of setting and documenting your firm's audit procedures and making sure that all your staff are trained in those procedures. How do we make sure that the staff actually do all this stuff? Simple. If anyone produces bad quality work, discipline them. And I suppose equally, those staff who do the best quality work, those are the people who should be promoted, get bonuses, and everyone should know about it. So it's very clear that good quality is rewarded and bad quality is punished. How do you know if you've got quality problems? You check. And the way we check quality is we do something called a cold review process. Which means that every few months we will pick out some work that has been finished, so it's too late to change it, and we will check those files to see if the firm's procedures were being properly followed. Once you've checked all of those files, you will write a report on the firm's quality position, you'll call all the staff together, and you will present the findings. So cold review file reviews are not being done to correct errors there and then. They're being done after the work is signed off so that you can learn if you have quality problems and then change things in the future. What about on each assignment we carry out? So a team of staff is going to be sent out to a client to do some work. You must ensure that the audit team is directed, supervised, and their work is reviewed. Especially the work of more junior staff. When you are deciding who should do which tasks on the audit, you should allocate work, fairly obviously based on skills, experience, seniority. If you read an exam question where the audit trainee is auditing financial instruments and pension schemes, and the audit manager is checking that the sales ledger adds up, that's not a very clever use of your resources, is it? All work should be planned, and all work done should be documented. And if you are auditing a client where you have a specific concern that quality might be a problem, so for high-risk clients, listed company clients, new clients and things like that, before the work is signed off, get a second partner to do a hot review. Now, you could argue that every audit should have a hot review by a second partner, but the danger with doing that is you suddenly end up incurring extra cost when maybe it's not necessary. You do extra reviews and checks only when it makes sense. Probably quality control will be done as a knowledge question. You might get something practical with a scenario, but on F8 it would seem fairly unlikely. To a certain extent, it's only just been added to the syllabus, and therefore we'll wait and see what the examiner does. I think the interesting thing is it got added to the syllabus, but the examiner did not write any article explaining how she'd examine it, which means she won't examine it in huge marks and will probably stick to just asking for the knowledge. Okay, fabulous. Well, we're about halfway through class number 3, so I think that's probably a sensible point for us to take a break. So we'll have 15 minutes. We'll start again at 7:40 UK time. I will see you then. Whoops, don't drop those. Okay, off we jolly well go again. So we have started to look at substantive testing. And so far, what have we seen? We've seen substantive testing on payroll expense, substantive testing on a payroll accrual, and substantive testing on bank. In other words, in all three questions, we have been given a number that appears in pretty much every company's accounts and just been asked, what tests do we do? And because those numbers appear in pretty much everybody's accounts, we can go with a standard list of tests, which is very helpful because if we've practiced in advance of exam day, then we've probably come up with the same ideas before. But there is another type of substantive testing question that comes up. And that other substantive testing style of question typically gives you two little stories. So instead of testing specific balances, we are now testing a story. So until you've read the story, you don't know which number or numbers in the accounts are going to be relevant. Now, I've told you that when you do substantive procedures, you need to think, which assertions are you trying to test? Think A-E-I-O-U, think DADA3. And all of that is fine. But if you have got a specific story, well, that story is going to tell you a few facts, and you might find it easier to simply test every relevant fact, event, or amount in the story. Because if she's feeding you this sort of detail, why not use it? Now, the best way for us to practice this particular area is, of course, to have a go at it. So have a go at it is what we are going to do. The next question we will therefore be looking at is also from the March-June 2016 paper. But this time it's question number 3. We've already done question 2, but now we're going to have a go at this one. So here we have question number 3 from the March-June paper. Let's have a look at what the requirement is asking us to do. It says, for each of the 2 subsequent events described above, so these 2 things will both have happened after the accounting year has finished. Based on the information provided, explain whether the financial statements require amendment. So that's going to require some accounting knowledge. And describe audit procedures which should now be performed in order to form a conclusion on any required amendment. Now again, it says procedures. It doesn't say substantive procedures. And if it is not specific as to what type of procedure, tests of control might be viable as well. But I would always go substantive first because my experience of these questions is that substantive tends to generate better ideas. Okay, so the total marks are split equally between the 2 events. So for each of the two events, one of which is a fire and one of which is to do with inventory, I have 5 marks to earn and therefore 5 things to try to say. So, do the accounts need changing? What procedures would I carry out? I would imagine that there must be at least 1 to 2 marks for do the accounts need changing, because you'd have to explain why. So as a rough guide, I think we are looking for about 3 audit tests. Possibly 4, but 3 as a minimum. Right, top of the question. Grains for You manufactures breakfast cereals and has 3 factories, 4 warehouses and 3 distribution depots spread across North America. Audit for the year ended 31st of December 2015 is almost complete, and the financial statements and audit report are due to be signed shortly. Okay. Profit before tax is 7.9 million. I wonder why you're being told that. Presumably so you can measure these 2 events against 7.9 million. In other words, for each of the 2 events, 1 mark is going to be for materiality. Why? Because the accounts need to be materially correct. So you could argue if either of these 2 events is not material, then the accounts would not require amendment. Following events have occurred subsequent to the year end and no amendments or disclosures have been made in the financial statements. Here we go then. Do the accounts need changing? What audit tests could be done? On February the 15th, 2016, a fire occurred at the largest of the distribution depots. Okay, let's stop for a second. The year end is the 31st of December. About 6 to 7 weeks after the year end, there is a fire. Well, if we're deciding whether the accounts need changing, and we are looking at events that have happened after the end of the year, it must surely be the case that one of the things we're meant to mention is accounting standard number 10, EARPs, events after the reporting period, and we're meant to say that these can either be adjusting to the year end that has just finished, if the event gives information about the company's year end position, or non-adjusting if it's irrelevant to the company's year-end position. But if it is non-adjusting, a disclosure note is required in the accounts if the event is material. Well, if a fire happens on February the 15th, that fire didn't exist on the 31st of December, did it? So that fire is irrelevant to the year-end position, and surely this is a non-adjusting event. Does a fire sound like it's likely to be material? Yes. Now, obviously I've not read any of the story apart from there's a fire, but in all likelihood this is going to be material and therefore a disclosure note is required, and I sort of know that already without reading any further. But reading further, we shall. The fire resulted in extensive damage at the largest of the distribution depots, so this has got to be material, hasn't it? To 40% of the company's vehicles used for dispatching goods to customers. Uh-oh. Does this also therefore mean they've got a going concern problem because 40% of their vehicles are out of use? However, there have been no significant delays to customer deliveries. Okay, that tells me this isn't about going concern. This is simply about there has been a fire. Do we adjust for the damaged vehicles or do we just disclose? The company estimates the level of damage to the vehicles to be in excess of 650 grand. Only a minimum level of inventory, approximately 25,000, was damaged. So we got 675 of damage to the company. Grain's insurance company, well, if they're insured, this could end up costing the company nothing. Has started to investigate the fire to assess the likelihood and level of payment. However, there are concerns the fire was started deliberately and, if true, would invalidate any insurance cover. Right, this is about IAS 10. So state the rules and then say a fire is non-adjusting because it's irrelevant to the year end. There is 675,000 of damage, and if the insurance doesn't pay, that is what it will cost the company in losses. So now I do my materiality. 675,000 divided by a number I've already forgotten, 7.9 million. $675 divided by 7900 is 8.5% of profit. And that is material. So as noted above, a disclosure note is required in the financial statements to describe the fire, the extent of damage, the insurance position, so that shareholders understand the situation. So those are the points regarding whether the accounts need adjustment. Is that really 4 separate bullet points scoring 4 separate marks? Doubtful. I suspect that's probably worth 2 or 3 marks total. So for safety, I would like about 3 procedures to help check this out. Simply test the relevant information in the story. What do I remember? Well, one thing I note is that there's an insurance claim, but the insurers are questioning whether or not it's going to be paid. I need to know the latest position on this. I will therefore inspect correspondence between my client and their insurer to help assess, always say why, the likelihood of any insurance payout. Because that will have to be described in the disclosure note, and I can't tell if the disclosure note is accurate if I don't know what is going on. What else does the story say? It says there was a fire and extensive damage. How would you know that a fire has taken place? Well, if a fire takes place and it's big, the local newspapers will report it. So I can look at those. The board will surely have an emergency board meeting to assess how much damage has been caused. So board minutes would help as well. So inspect press reports and board minutes. Always say why to verify the date and extent of the fire and the damage, and to confirm the board's plans to get the company activities back up and running. I agree, Lorraine, absolutely. The question also says that 40% of the company's vehicles have been damaged to the tune of 650,000 plus and 25,000 of inventory damaged. How do you know that that is the quantity of damage caused? We need to know how many vehicles were parked at that site just before the fire happened, and we need to know how much inventory has been damaged as well. How would you know? A-E-I-O-U. You could enquire of the staff who work at the depot and ask them how many vehicles, how much inventory. If the fire was not that long ago, it might even be possible to visit the site and inspect the damage. Now, that one is a bit difficult for me to comment on because the ACCA no longer tell us which questions were on which sitting. This is the March and June sitting combined. And therefore, I don't actually know what today's date is. Is it March or is it June? If it's March, and this fire only happened a couple of weeks ago, it might be possible to inspect the site and be able to see how many damaged vehicles there are. Now, I'm going to stop writing at that point because I have enough tests for this. The asset register of that site should say how many vehicles are located there. But the problem with that is vehicles have wheels and they tend to keep leaving and coming back doing trips. So knowing how many vehicles are usually based at the site is helpful, but you don't know if they were actually there because they could have been driving around at the time. And that is how I would deal with the first one. It's testing your ability to come up with audit procedures, but also it is testing your accounting knowledge. Now, accounting, of course, is technical and sometimes will be a little difficult. So the easiest marks to obtain here are surely the materiality mark, the audit tests, and the hardest bit is probably explaining the accounting rules. So if you're running out of time or a bit nervous about your accounting knowledge, get the materiality marks and the procedures. And then we have a second one. Inventory. So let's see what it says about that. On the 18th of February 2016, 3 days later, it was discovered that a large batch of Grain's new cereal brand Loopy Green Loops held in inventory at the year end was defective as the cereal contained too much green food colouring. Okay. To date, no sales of this new cereal have been made. The cost of the defective batch was $915. Defects cannot be corrected. However, the scrapped cereal can be utilised as raw material for an alternative cereal brand at a value of $50,000. Okay, so the accounting issue here is again event after the reporting period. In this case, some quality control testing. So Are the results of that quality control testing an adjusting event, a disclosable event, or nothing? Well, the quality control has shown that inventory that existed at the year end has been found to be faulty. If that inventory has got too much green colouring in, that must have been put in while it was being made, so that problem existed at the year end, didn't it? So the post-year-end discovery of that problem is an adjusting event because we have discovered additional information about the year-end position of that inventory. Now that we know an adjustment is required, the question is, what adjustment? Well, this is inventory, and under IAS 2, inventory should be held at the lower of cost or net realizable value. The cost was 915. What can you actually get from this inventory? Well, the best you can get is to save 50,000 by not buying a raw material and using this stuff instead. So the NRV seems to be 50,000. So at present, that inventory is overstated by 865. If you don't know the actual IAS number, what alternative would be correct to use IFRS? I'm sorry, Lorraine, I actually have no idea what that means. What alternative would be correct to use? Oh, what alternative would be correct to use? IFRS. No, the IAS and IFRS are the same thing. They were called IAS up until, I don't know, 15 years ago, and then they started to call them IFRS. They're the same thing. IFRS is just a new name for them, that's all. If you don't know the number, who cares? There are no marks for the numbers. Just say inventory should be held at the lower of cost or net realizable value. If you know the numbers, I think it's nice to put them in the answer, but it's certainly not compulsory. Right, I must apologise. I've got a problem with my eye and I just need to fix it. Not quite sure what's going on here. No idea what's going on, but we'll just have to carry on. So I'm struggling seeing a little bit here, but I'm going to have to wear the glasses, I think. Right, we now know the relevant number. The relevant number is 865. So now we can do materiality. Is 865 a material adjustment? Well, 865k divided by 7.9 million is 10.9% PBT, which is also material to the profit or loss. And inventory is in profit or loss in cost of sales, isn't it? So, now we need some procedures. Again, probably the best thing to do is go read the story and test the details in the story. What details are there to check? Well, the story says that at the year end, there was 915,000 of this stuff sitting in inventory. So I would have thought it would make sense to inspect the year end inventory list to verify it does include a 915k batch of this product. It says that in February it failed some sort of quality control test. So I would like to see a copy of the test results to verify the inventory is defective and cannot be sold. They are planning to use it in place of another raw material in another product. How do you know what they're planning to do with it? Because their plans could be in the directors' heads. But if the directors have decided that's what they're going to do, I would have thought they would have discussed that at a board meeting. So I would inspect board minutes to verify the intention to use the product to replace a $50,000 raw material in another product. So notice here that all I'm doing is simply checking anything that looks interesting and relevant in the scenario that's written in the question. Makes life so much easier because you are able to test the facts in front of you. So use them. Also notice I always say why I'm doing the test. I don't just do a test. Now those questions are quite common. She seems to like setting those a little bit more than setting the how would you audit that number, how would you audit that number type. And I would say you're in with a very strong chance of something like that appearing within the long questions in your exam in just under 2 weeks' time. Yes, there is the question of how did they get the 50,000 figure, isn't there? Presumably they've looked at this cereal. They've looked at another product, they know how much material they need, and this cereal seems like the right quantity, so I don't know, would production staff be able to confirm this? But the fact is I've got 3 tests already, so I'm happy. But yes, Ashot, the test you suggest there is absolutely fine. Okay, so let's just make sure we're keeping track of what we've done. And we've done that, and we've done that, and we've done that. We've done that, and we've done that. So, time at that point to move away from that question, and time for us to do another little bit of some technical revision. So time to look at another audit standard, and the one we're going to look at here, ISA 610. And this standard looks at external auditors relying on the work of their clients' internal auditors. Okay, so what's the issue here? The issue here is that as the external auditor, I want to do an audit that's as efficient as possible. If my client's internal auditors have already done some tasks which I also need to do, well, if they've done them in a reliable and good quality way, maybe I can rely on their results instead of repeating the stuff myself. And one thing that your client's internal auditors are going to be doing all year is they've been testing the internal controls. Well, if they've already tested them, maybe I can avoid doing my own tests and just nick their results. But if you are going to place reliance on someone else's work, you need to check that both they and their work appear to be reliable. So the external auditor can rely on this. But first, you need to check the reliability of the internal audit staff who've done this work and the work itself. And normally, if we're going to rely on anybody else, the three key things we ought to check: to what extent are these people professionally qualified? How much experience have they got in testing controls? And we need to assess how independent the internal audit staff are from the company. And if they look like reliable people, we'll then take a look at the work they've done and we will re-perform a sample to see if we get the same results. Because if our results match theirs, it implies, it does not guarantee, but it implies that they have done the work properly. In which case, take a copy of all their work and use whatever you can. Now that bit of relying on internal audit has been around for years. But one of the reasons I'm looking at this audit standard with you on this revision course is that within the last 3 to 4 years, this audit standard has changed. It's been added to. Because there is another way that we might want to rely on the client's internal auditors. Because we could borrow the client's internal audit staff to help with our audit tasks. Now, of course, you can't just walk into the internal audit department and say, "Oi, you, here now." That's not how it works. But your client might say to you early on in the audit planning process that their internal audit staff will have some spare time during your audit, so if you want to borrow them, feel free. Of course, the client is suggesting this in the hope that since they're already paying their internal audit staff, you can send some of your team back to the office and the bill for the audit should be lower. So, can you borrow the client's own internal audit staff and use them to help with your external audit work? And the answer, maybe slightly surprisingly, is yes, we can. There's always a but, isn't there? If you're going to put these people on your audit team, you will need to check that they are good enough quality people. So check their qualifications, experience, and of course external audit teams must be independent. And the second issue is if you're going to use them, you should only use them for low risk items and non-judgmental items. So you could use them to check the depreciation calculations because that's a fact. They're either right or they're wrong. You could use them to make sure the sales ledger adds up. Check payroll calculations. Agree numbers back to invoices because all of these are relatively simple, factual tasks. You do not get the internal auditors to give opinions on whether the accounting policies in use by the company are okay. You don't get internal audit to check whether provisions are required or contingent liabilities, or check fair values, or anything else which is a matter of opinion. But for simple fact checking, if they're available and they can do it, why not? And if you've got any question mark about that and think that's not right, please bear in mind that several members of your audit team are unqualified junior staff who, to be frank, know virtually nothing. And you're quite happy to use them, aren't you? So there's no problem using the internal audit staff. You just put them in the team, review their work just like any other member of staff. So yes, you can. Can you use them in the inventory count at the year end? I suppose you could. But to be honest, they're probably going to be involved in assessing the inventory count for the client anyway, because that's an internal audit task. If you've got a client with 25 locations and your audit staff can't attend all of them because they're all being counted at the same time, you certainly could talk to the internal auditors and say, look, which ones will you attend? And then the external auditors could attend different ones. And then you could pool your results at the end. So you could do that, yes. But for something like an inventory count, they're going to be there anyway. So that was Audit Standard 610 and relying on the work done by internal auditors. So far, we have looked at ethics, we have done internal controls, we've done risk and response, and we've now done quite a lot of substantive procedures. We have revised audit reports, but we've not actually done anything, I think, which has had audit reports in the question. So I think at this point it would be very wise to take our knowledge of audit reports that we've revised and take a look at a question and see how it comes up. Now, normally, audit reports are the end of a question that's been doing something else. We're going to take a look at a couple of audit report questions, and we are going to start with a question where we're only going to look at the final part of it. June 2014, question number 6. As you can see, we've done a bit of June 14 already. Sorry, not number 6, number 5. There is no number 6, which would make life a little bit difficult. Now, the only reason I'm looking at this particular question is for the very last part of it. By all means, practice the other bits, but the majority of this question are parts B and C worth 12 marks. A very common question type to come up. What indications or clues are there that this company has going concern problems? And what audit procedures would you do to check? And the only reason I'm not going to do that question during this revision course is these requirements also came up on the very last paper that we've had. I don't think I've ever seen this come up twice in a row, so the chance of it coming up for you is so small. Doesn't mean it won't, and you should practice it, but given the limited amount of time we have in class, I think I should focus on other things. It's also not very difficult, by the way. But what I want to do is have a look at the last bit of the question, because it's got audit reports in it. In this question, the company are looking to extend or get a new overdraft facility because they're struggling with cash flow problems. The auditors have been informed that Clarinet's bankers will not make a decision on the overdraft facility until after the audit report is completed. Now, there's nothing odd in that. Presumably the bank want to see the final accounts and the audit report to see how bad the company's situation is before they decide whether to risk lending more money. The directors have now agreed to include some going concern disclosures. Okay. For 4 marks, and so we want to try and say 4 things. Discuss the impact on the audit report of Clarinet if the auditor believes the company is a going concern, but that this is subject to a material uncertainty. Now, I notice we have a question and breakup basis. So let's use this as an opportunity to revise the whole lot, and then I can answer that question by Sadiku and the question we've got in front of us. There are basically 3 possible situations for a company regarding going concern. The company is a going concern and there are no uncertainties. Or the company is a going concern, but material uncertainties or an uncertainty exists. Or finally, in the auditor's opinion, the company is not a going concern, and you think the company is going to collapse. What do the accounting rules say about all of this? If a company is a going concern, then they should use the going concern basis of preparing the financial statements. You assume the company will carry on trading. And if there's no uncertainties, no disclosure note is needed. Other than the normal disclosure note that says the accounts have been prepared under the going concern assumption, and that'll be it. If you think the company is a going concern, you expect on balance of probabilities they will survive, but there is a material uncertainty, then the company should use the going concern basis but because there is a material uncertainty, there needs to be a disclosure note in the financial statements explaining the material uncertainty relating to going concern. If the company is not considered a going concern, then fairly obviously they shouldn't be using even the going concern assumption, should they? Instead, they should prepare the financial statements on the assumption that the company will be broken up and sold or disposed of. In other words, the breakup basis. What exactly does that mean? Well, if the company is likely to be broken up, how would you value tangible non-current assets? Well, number one, they're not non-current assets anymore, because if you're expecting them to be thrown away or sold within the next 12 months, they're current assets. Number two, if the only intention is to sell them or throw them away, you value them at sales price. And if you can't sell them, they're worth nothing. So no more cost minus depreciation rubbish. Selling price. Next time you walk past a shop that is closing down, note what it says in the window. Closing down sale. If you're closing the company, there's a strong chance a lot of the inventory will be sold at less than cost, which means inventory is probably currently overvalued. Your customers who owe you money hear that you're going out of business and they won't pay you because they hope you go out of business before they have to. So now you've got a lot more bad and doubtful debts. And when it comes to liabilities, if the company is suddenly going to close, you'll need a provision for redundancy costs for your staff. You'll probably be breaching every contract with suppliers and customers, so you'll need provisions for those. And all of those liabilities need to be put in the accounts so that if the company does close down, the insolvency practitioner can rank all the people who are owed money and make sure the right people get paid in the right order. In other words, your accounts totally change. And that is the breakup basis. So as an auditor, what is my job? My job is to assess, are they a going concern, and are there any uncertainties important enough that I think the company should disclose them? So those are the rules. Now, no problem, sir. Or madam, I am making a big assumption there. No problem, Sadiku. Now what we've got to do is answer the actual question that we've got. What is the question we've got? Good question. Where is it? That one. There we go. Right. The auditors have been informed that Clarinet's bankers will not make a decision on the overdraft facility. There's the uncertainty. The directors have now agreed to include some going concern disclosures. It says here the auditor believes the company is a going concern. So let's have a look at what's up on the screen. And quite clearly, this is the situation, isn't it? This company is a going concern, but there is a material uncertainty. What is the impact on the audit report? I don't know. Has the client got the accounts right? Well, the question says there are some disclosures. If the auditor believes the client's disclosures are sufficient, then we'll get one answer. If, on the other hand, you think these some disclosures are not sufficient, we'll get a different answer. If you think they are not sufficient, then you believe that this company has not followed the accounting rules on going concern. In other words, you believe the accounts are materially misstated due to under-disclosure. So you're not challenging any of the numbers in the accounts. You're saying something that should have been disclosed under accounting standard number 1 has not been disclosed properly. Well, it's only one mistake, so I would suggest this is a material problem, but is not pervasive to the financial statements, because there's only one thing wrong. And therefore, surely what you need is a qualified audit opinion, except for. So your opinion will say, except for the failure to disclose certain information about the going concern uncertainty, the financial statements provide a true and fair view. And as with always the case where you modify the opinion, you will explain the missing disclosure in the basis for opinion section. So they have disclosed something. If you don't think it's good enough, that would be the answer. If, on the other hand, you believe their disclosures are fine, then the financial statements, correct's not a very technically correct word, are true and fair, because the company has correctly followed the relevant accounting rules. And if the financial statements are true and fair, your opinion will be unmodified. However, because the company has disclosed a material uncertainty related to going concern, we need to add our own material uncertainty related to going concern paragraph directly below the basis for opinion, and that paragraph is used to highlight the going concern disclosure in the financial statements. So it will literally say something like, we direct shareholders' attention to note 2 to the financial statements, where a significant going concern uncertainty has been disclosed in full by the company. And you'll also make clear in this paragraph that this has no impact on your opinion on the financial statements, because the financial statements are fine. And that is what I would be putting in the answer. There's a sort of clue here in that there are 4 marks available. And the danger is you see there are disclosures and you say, well, we must highlight those disclosures with a merge paragraph in the audit report. Congratulations, you've earned 1. If it's worth 4, you have to go somewhere else with this. And whenever there are disclosures, you can't decide what your reaction to them is until you've read the disclosures and decided if those disclosures are presented in enough detail. Thus, there are 2 possible answers here. The disclosures are good enough, or the disclosures are not. While we're on the subject of this, please be aware that the answers on the ACCA's own website, the Examiner's Solutions, are the original solutions written at that time. As you know, audit reports have changed, which means if you go and read the answer to this question, it's not going to exactly mirror what I've done up on the screen because the rules have now changed. Okay, wunderbar. Well, we have at that point got a masterfully huge 8 minutes left. And in 8 minutes, I think probably the best thing I can do is fill it up with a little bit of technical revision, heading in to the last few things that we need to revise in the final session. In the September exam that we had a couple of months back, from what I can tell, there was virtually no corporate governance and virtually no internal audit, which tells me that on your paper, both of them are bound to be there. And it wouldn't surprise me if in both cases they appear somewhere within the long questions, not just as multiple choice. So what sort of exam questions do we get on corporate governance? Well, the bit of corporate governance which gets tested the most, well, this is an audit exam, so it's no great surprise. It's audit committees. What are they? What do they do? And what benefits do they bring? And it has been a while since that was tested, so that has definitely got a chance. Oopsie daisy. And then the other thing that tends to happen is a scenario style question, and your job is to criticise the company's current corporate governance. And the only real problem with that is that in the story they could be breaching absolutely any part of the UK Corporate Governance Code. Which means you need to know enough of what the UK Corporate Governance Code says to be able to spot enough of the things they're breaching. And it could be anything. So, let's have a little reminder of what sort of stuff the UK Corporate Governance Code covers. Now, I'm not going to repeat every last thing at you because that's pointless. It's in the original class notes. And if push comes to shove, the Corporate Governance Code is on the internet. You could go and read it. What I'll do is summarise the main areas it looks at. The biggest area is it looks at the board of directors. It looks at what the chairman should do, what the chief executive should do. There shouldn't be any links between the chairman and the CEO, because if they are linked, that means you've got a very big power base between those two people. We'd like them to be separate from each other. Governance looks at the structure of the board. So things like at least 50% should be independent non-executives. You should have some diversity on the board, you know, women as well as men, people from different ethnic backgrounds, different ages. And overall, the board, rather like a football team, should have enough elements to provide all the various skills that the team needs. There should be an annual evaluation of the board's performance and the performance of each individual director. And of course, the board should have some committees. And the UK Code requires 3 of them. A nomination committee to help choose new directors, a remuneration committee to set directors' pay, and the audit committee, who, guess what, are something to do with audit. Come back to them soon. The second area that the code looks at is directors' pay. A very thorny and sensitive area. And the main thing it highlights is pay should have a big performance-related proportion. So if the company does well, the directors are allowed to do well. If the company's doing badly, the directors should be suffering just like the shareholders. A third area, and very relevant to us as auditors, is audit and accountability. Companies should have an internal control system, a risk management system, and good quality financial reporting. Should consider having internal auditors to check the internal controls and risk management. And all of the above should be overseen by the audit committee. And then the final bit that governance looks at is communication between the board and the shareholders. And the 2 most obvious things in there are have your normal annual general meeting with the shareholders. But if there's something important, don't wait a year, have extraordinary general meetings for any important matters. Now what I've done there is a very heavy summary rather than absolutely everything. And you do need to know as much of the governance as possible, because if one of those questions comes up that says here's what the company does at the moment, literally anything could be breached. But as long as you know a pretty good range of things, you should be able to spot enough to come up with the answer that you need. Right. Well, that leaves us with audit committees, which we'll look at next time. We also will need to look at internal audit next time. And we've also got a little bit more substantive procedures to look at next time. A few other bits and pieces. But that is the end of revision class number 3. We've had a good night tonight. We have looked at several questions. We've seen lots of practice on substantive, plus we've managed to do some audit reporting as well, so good stuff. If you've not already attempted the mock exam, I think the deadline is 12 noon tomorrow UK time, so go and download it. If you can't get it done by the deadline and upload it again, you can always do it and email me your answers. Obviously, it's better if it goes through the process, you know, internal controls and all that. And if you are going to delay getting it to me, please, as soon as you can, because we're less than 2 weeks from the real exam now, and the longer you leave it, the harder it will be for me to mark it before exam day. Bear in mind, I'm still teaching. I've still got other revision courses to teach. So the sooner you get it, the sooner you'll get it back. But apart from that, thank you all very much for your sensible questions and your attention this evening. Well, you can... Oh, right, so you couldn't submit it within the 4 hours. Fine, email it to me then. No problem. I look forward to it. Thank you all very much, and I will see you again next week for the final instalment when we bring all of this together. But for now, good night. My email, pmorison@lsbf.org.uk. Okay? Good night, everybody.